Hello again, this is Alex with MasterChartsTrading.com and this is Market Recap for Friday, March 3rd, 2017. So again, we're seeing all-time highs, all-time closing highs in the major indices. The S&P 500 did touch the pivot point. We'll look at that. There are some breadth divergences in IWM. We'll look at that as well. We'll look at some of the sectors, including defensive ones, that are hitting fresh highs as well. We'll look at bonds a little bit more detail this week, and we'll look at the investment grade ones. They did sharply drop this week, but maybe this is a buying opportunity. Who knows? We'll also look at the forex universe. Mexican peso rallied pretty sharply, so this could be one of those sell the rumor, buy the news kind of deals. As the dollar is rising, gold is under pressure. Gold miners, we'll look at that. And also I'll show an example of a recent trade that we did at MasterChartsTrading.com, and that is of GDX. Also we'll look at oil, and it's possible that third time would be the charm for oil bears, and XLE could be the leading indicator. And finally we'll look at natural gas, which could be finally done correcting. All right, let's start with S&P 500 ETF SPY. This is a daily time frame, and this is a total return index. In other words, the dividends are added back into the price. So Wednesday here, I see we had a gap up, and we gapped to all-time highs. We closed at all-time highs. Next day, however, we see big red candle, so basically wiped out the entire gains. Then the day after, we kind of just tried it more or less in a very tight range here. This gap sure feels like an exhaustion gap, and exhaustion gaps are kind of gaps that are at the end of a move, and this is sort of a thing that kind of like the investors are seeing, oh my god, this trade is getting away, let me go ahead and buy, and they jump in at the very last moment here, and they hope that it will go to the moon, and what happens next, it doesn't. So it will only be known in the rear view mirror if this is indeed an exhaustion gap, but it is possible that this is indeed a end of this move, because it looks like we had a gap here. Maybe this is the end of the line for this move. Generally speaking, longer term, the market is very bullish. There are no major divergences that I'm aware of. So, for example, advanced decline lines, all-time highs, advanced decline volume line, also all-time highs. It's a little bit longer term time frame for S&P 500. Here, what I wanted to point out is the longer term, the percentage of stocks above the 200-day EMA. No divergences. We just hit the high for the move. We're at 85 right now. Before, we were here topping out around 81. So this is a bullish chart with a confirmation from market breadth. Same goes for bullish percent index here. This is a high for the move, 79.6%. We used to be here at 76%, so looks like there is no divergences. So this is very positive indication, that this is a broad market rally. If we go look at the weekly time frame for S&P 500, now here's what I see here on this chart. So I put in pivot points, and you can look up pivot points. It's pretty useful indicator. So looks like we pretty much touched this pivot point, or almost touched it, and this is a yearly pivot point. So in other words, this is from a weekly charts. So maybe this is it. This is a very large advance. I mean, if you start from here, from 2016, we can see a very large continuous advance basically. And also like this part here, this advance is basically equal to like this advance. We're more or less getting to the point of where this move, consolidation, another move. So it looks like we're probably getting to the point of where profit taking most likely will commence. Whether or not it will actually happen remains to be seen. It is also possible we will continue higher to resistance 2, or we might completely unravel and drop. Anything is possible in the stock market, but how likely are those events? So my best guess scenario is we basically either trade sideways and maybe we'll pull back slightly, but that slight pullback most likely will be a buying opportunity. This is a weekly performance chart for the S&P 500, S&P 1500 market capitalization. So actually, it should be said 5 days. So for the 5 days, 5 trading days, you can see it was basically a large cap market. Large caps gained, mid caps actually lost, and S&P 500 small caps lost over 1%. So overall, the market slightly gained. S&P 500 itself gained slightly. So, let's continue on basically, and we'll see where there is any weakness or strength. And of course, there's plenty of strength in the QQQ, the technology. And this is a very strong move from November lows. I pointed this out repeatedly that this was a buying opportunity. Basically, very strong move. I also repeatedly pointed out that you should avoid shorting this chart, especially beginner traders. In general, should probably avoid shorting equity. It is very tricky. Equity has this weird tendency of just keep going up. So here's a long-term line for QQQ. If you just go out, I don't know, 15 years, general trend is up most of the time. Occasionally you get bear markets, but those are tricky to time. So beginner traders should definitely avoid shorting. QQQ itself right now definitely overbought, but that doesn't mean anything. That means that there was so much buying pressure that it became overbought. As far as the long-term posture on the market, I definitely think that this is a bullish security, which is confirmed by long-term indicators. For example, here's percentage of stocks above the 200-day at 89%, and also no divergences here. Bullish percent index also at very high reading here without divergences. So QQQ and technology in general is very strong and continues to be strong, and probably will, if we do get a pullback again, it should be viewed as a buying opportunity. Here's we get into a little bit of weakness. This is IWM. This is not really a weak chart. It's just kind of underperforming, I guess is the word. We had initial post, around November election surge, very just sharp, powerful surge, and basically very long-term sideways consolidation, and then now a breakout to fresh highs, and these are all-time highs, again trading sideways. What concerns me about this chart is the presence of divergences now. So we have, first of all, this is advanced decline line. We see a divergence on that, mild one, nevertheless it's there. Advanced decline volume line, also a divergence here. And this is a breadth momentum oscillator, which is an oscillator of the advanced decline line. You can see a clear divergence here as well. So you can see that it is higher here, right there, versus here. Just on March, and you can see that we made a higher high. So this is a clear divergence. Whether or not it will resolve to the upside or the downside remains to be seen. The general market is overbought, so I'm sensing maybe the IWM is the canary in the coal mine, basically. Here's IWM again on a slightly longer term time frame. Here you can see obvious divergence as well. You can see a higher high here. But for example, here is RSI, another market momentum indicator. You can see a lower high here. So this is a divergence. A bunch of divergences here in the percentage of stocks above 20, 50, and the 200-day exponential moving averages. You can see that we're not, the advance is not being confirmed by the market breadth. Can they resolve? Absolutely. And can we, break out and continue higher? Absolutely. It's entirely possible. However, the general market is overbought and in need of a correction. So maybe this is like a canary in the coal mine again. So it's possible we'll drop. Here's price momentum oscillator, basically a MACD with a different setting, but also you can see a divergence here. So to summarize, generally speaking, the stock market is very bullish, but maybe we're seeing a little bit of a weakness creep into the market, especially from the small cap part of the universe of stocks. So what about the blue chip stocks, the Dow Jones Industrial Average? Very similar pattern to S&P 500. For all practical purposes, these are, in my opinion, interchangeable. So the Dow and S&P 500, you can see they're very similar charts. So as far as the Dow Jones Industrial Average is concerned, same thing. We have a gap up here, and this is actually a stronger chart because you can see that we didn't even begin to close this gap, whereas for S&P we began to close the gap immediately. So clearly a preference by investors towards the large cap universe of the stocks. We're still hitting all-time highs on advanced decline lines, advanced decline volume lines. So this is a bullish chart. Again, any pullback should be viewed as a buying opportunity. Last week I went into quite a bit of detail whether or not the stocks will experience a 2015 style plunge. And you can actually Google this. You can just look for my Twitter handle, which is MasterChartsTrading. This was tweeted out last week on 26th February. So you can Google this and find out. I go into quite a bit of detail. You can just click on this link. It is 5 minutes, 5 seconds from last week's video. But the Dow Jones, I think, again, is a bullish chart, and again, once again, any pullback should be viewed as a buying opportunity. All right, let's briefly go over some of the sectors, major sectors of the United States stock market. Here's XLF financials. Again, the bonds dropped. When I get to bonds, we'll go into some details on that, but the bonds dropped, and financials like when the interest rates are higher, so they pushed higher. So far this is a strong looking chart as well. Also, I don't see any bearish divergences, so this is again a bullish chart and should be viewed as a buying opportunity when there is a pullback. XLY, consumer discretionary, it's slightly weaker than the rest of the market. You can see that we did not make a fresh high in the advanced decline volume line since December of last year. So there's a little bit of a divergence, albeit a very mild one. You can see 5909.24 at 5909. I'm not even sure if this is something worth mentioning, but it is still there for now. Here is industrials, one of the strongest charts out there. From the major sectors, again, all-time highs. Same thing, no major divergences just yet. So this is a bullish chart and should be viewed as a buying opportunity on any pullback. XLV healthcare, this one I kept pointing out. This is advanced decline lines, and here we had all-time highs on advanced decline lines since beginning of January, and you can see that the all-time highs on this chart were nowhere near. We're like back here, but now we just had this big rally, and XLV just broke out to fresh all-time highs. So even though it's a slightly defensive sector, it is still a stock market. It's still stocks, they're not bonds. So they follow the general market and they caught up to the general market. So this is a clearly, again, to me, in my opinion, a bullish chart, and again, should be viewed as a buying opportunity if there is a pullback or when there is a pullback. The same thing applies to consumer staples that I just mentioned for XLV, for healthcare. These here were all-time highs in advanced decline lines, and I repeatedly pointed them out. So again, this was simply underperformance. This was not a bearish chart, as some other commentators mentioned. This was, to me, a buying opportunity, and now we are at all-time highs. Here's real estate. This one is a little bit of a mixed bag. Plus, we don't really have advanced decline lines, and I hope, as you know, StockCharts.com finally creates a advanced decline line for this sector, because this is now an official sector. It is no longer an industry group. So, in any case, this is still, I think, a bullish chart, and you know, it's underperforming. I think, due to drop in bonds, because real estate is more tied to the interest rates, obviously, than the rest of the stock market. But these are still stocks. These are real estate investment trust stocks, so they should be grouped as stocks. And I think that this is a, you know, most likely, especially if we see a rebound in bonds, this could benefit strongly. This real estate could benefit strongly. And here's a proof of that. This is utilities, which are also considered to be quote unquote strongly dependent upon the rates. To me, they're more of stocks than anything else again, and I think, I treat them as part of the stock market, not bond market. So also bullish divergences here, and I kept pointing them out. This right here is an all-time high in the advanced decline line, and this was in December. And all-time high in utilities were like back in July of last year. So this was a bullish divergence and a buying opportunity. Now we are at all-time highs in advanced decline lines, and we're like within just like literally a couple of points away, where the all-time highs were 52.07, we're at $52, so very close to all-time highs. And if you look at this chart, this could be like a cup kind of thing, and we could break out to fresh highs and continue higher very easily. Finally, here is junk bonds, and I kind of group junk bonds together with the stock market because of their high correlation to the stock market. You can see very high correlation of junk bonds to S&P 500, all-time highs, all-time closing highs, very bullish chart, and this is confirming a bullish stance on stocks. Here's the same chart, but on a weekly time frame. This chart includes dividends. So if you take out dividends, the chart will look completely different. So let me just show you what I mean. You can do an underscore, symbol. You can see that these are not all-time highs if you take out dividends. But since this is a highly, dividend-paying security, I tend to kind of put together a as a total return index. So this is a all-time highs, and again this is confirming all-time highs in the general stock market. And again, the reason is because I group junk bonds together with the stock market. You can see very high correlation on the longer term time frame as well. All right, let's move on to bonds. So this is TLT, total return. In other words, the dividends are added back into the price. So it's kind of difficult to see where bonds are going. Just let me just go back to weekly chart for a second. And up here, well, these are all-time highs, so I had absolutely no doubt that this was a bullish security. Even down here, when we dropped, let me see how much, like 8% from the top, I had pretty much no doubt that we're bullish security, even though we broke the support. Now then we had this big drop here, so we continued lower and we actually hit 52-week lows. So here I was much more worried that this is indeed now a bearish security. But now just judging from the intermarket analysis, in other words, looking at bonds and stocks, put together, so to speak, the stocks are very overbought. The bonds are actually sort of oversold, if anything, because we can see that we're trading close to 52-week lows. This is a 52-week lows right here. So if anything, it's possible though, even though we had this big drop here, you can see that we again, we have hammer-like candlesticks. You can see that there are investors coming in and buying in this area. We had a hollow red candle right here, more hammer-like candlesticks here. So this area here at 118, maybe 117.80, 118, seems to be like a support area. And it's possible that we're going to hold here. Plus additionally, the if you're want to buy the security, where would you want to put your stop? And the obvious place to put your stop is below this low here. So right now the risk is quite low. The risk is what is it? About 2.5%, while your potential gain is actually significantly higher. You could easily see this gap closed, so that's about 7% right there. We can rally to the 200-day moving average, possibly higher. So now that I wonder if since the stock market is so overbought, maybe the bond investors are actually already coming in here and buying at this area. So even though we had this big drop, I wonder if this is a buying opportunity. So the same thing goes for AGG. This is a little bit more stronger than TLT. Let me show you what I mean. Whereas TLT on the weekly time frame, you can see it's not that far off from the 52-week lows. AGG is, it's significantly further away from the 52-week lows. And another fund that I follow is LQD, which is a corporate investment grade bond. You can see there it went off quite a bit higher than the TLT. And this one, LQD, I can make an argument that this is a bullish chart, and I kept pointing this out, by the way. So we had a breakout here in 2016, and a breakout above this level here, continuation to 52. Oh, that's actually all-time highs, and this is total return again. Including dividends, a pullback, and a pullback exactly to the previous broken resistance, and now a bounce off of that resistance. So for now, I can just say outright that this is a bullish chart, probably, LQD. But going back to TLT again, it looks like investors are really holding the support, and bonds are not really dropping much lower. So again, I wonder if this is it for the drop in bonds. Okay, moving on to the Forex universe. This is United States dollar index on a daily time frame. I think this is a bullish chart because these are multi-year highs, and now we're having a normal pullback. In fact, we had a normal pullback to the previous obvious support level, 99.25. We pierced through it, took out the stops here. In other words, what happened is we had a drop, and big money players were waiting for the weak hands to basically let go right below this level. They grabbed those contracts and pushed the prices higher because they started buying down here. So for now, this looks like a pretty classic kind of breakout, pullback, continuation higher. So for now, I don't see any major issues with this chart. This is still a bullish chart to me. Here's the weekly time frame for that same chart, and here's that same 99.19 level from this spike right there. Again, this is a fourth week of dollar appreciating. So 1, 2, 3, 4. So can we continue higher and break to fresh multi-year highs? Of course we can. We can also trade sideways, or we could drop from here. But in the long term, I think this is a bullish chart. So the reason why I think this is a bullish chart, this is a weekly time frame. is because we had a big breakout, a 2-year consolidation, and now we have a breakout right there. And this pullback is like a throwback to the breakout level. So we're basically there, and now we're continuing higher. There could be a lot of back and forth, but I think this is a bullish chart. And when we get to gold, this will weigh on gold significantly. Going on to the Forex, this is Euro versus US dollar in the weekly time frame. So these are multi-year lows here. So this is a bearish chart. You can see a big drop, 2-year consolidation. It's like a mirror image of the dollar. And the reason is because I think like 50% of the US dollar index is euro. So we have big drop, couple of 2 years of consolidation, couple of rejection spikes, and then fresh multi-year lows. But then we had 1, 2, 3, 4 weeks of bottoming action and a rally. And this rally pretty much took it to the previous broken support, which was around this highs here and the breakdown right there. So we almost got there. I was actually kind of surprised we didn't get slightly higher, but it looks like we didn't get there, and it's also completely possible that we'll just continue lower. We didn't even take out the stops above this high, so I'm a little surprised how strong this selling is, but in the stock market and forex market, anything is possible. Going on to British pound versus the euro, couple of there was an inside wick here, and now we have a bearish resolution to this inside wick. So let me zoom in significantly, and I'll show you what I mean by that. So here is that inside wick. So this wick right here from February 13. The range is entirely within the previous wick from February 1st. You can see it's kind of like a triangle consolidation, but now we have a clear breakdown from the triangle consolidation. And since this is a bearish security, we could potentially take out this low here with another move lower versus the dollar. Here's US dollar versus Japanese yen. It's just reversed, basically. The way it's traded in the forex market is just reversed. But yen in this case is losing grounds versus the dollar. In other words, the dollar is winning this battle. So we had a surge and now a normal pullback. These two hammer-like candlesticks, I thought that was it. This was clearly not the case. We actually broke below those levels and closed below those levels on a weekly basis. But now it looks like we have a bullish engulfing or outside reversal on the weekly candlestick right here. So this looks to be this looks to be quite bullish, and we could actually continue higher and maybe even take out this high here. In other words, the yen will continue to depreciate versus the dollar. Here's the Canadian dollar. If you listen to my previous videos, I pointed out this level here, and looks like we held it. We held this level and rallied strongly this week again. More back and forth is possible, but if this level doesn't hold, there's very strong support here at the previous levels at like 128 or so. And finally, here is Mexican peso. Again, it's traded the opposite, so US dollar slash MXN. In other words, up to here, Mexican peso was losing horribly, and these are actually all-time lows for Mexican peso, so it's inverted. So if you go to Mexico, your $1 will buy you 22 pesos, and that's a lot. I used to travel to Mexico, and I think it was like 12 back here. So it's pretty incredible how low the Mexican peso went. But it's entirely possible that that was it. So now it looks like we have a strong move lower here. So we're kind of at the moment of truth for Mexican peso. If we maybe rally here, you know, and make fresh highs versus the Mexican peso, then of course this move is not over. But maybe we rally slightly and then drop further, and we would take out this low here from November of last year, from basically from the election spike. That could mean we have a reversal on our hand, and this was what I mean by you know, sell the rumor, buy the news, basically. So the traders were selling the Mexican peso, but then recently, when President Trump started saying that maybe the Mexico won't pay for the wall after all, maybe this is what they're saying. Now they are no longer so bearish on this Mexican peso. All right, that's it for Forex. Stay tuned for the gold market. All right, and here's gold on a daily time frame, continuous contract. So a relatively powerful rally of the lows here, December lows, continued higher with a takeout first resistance area, continued higher. We basically got to the second resistance area from the broken support. The broken support was right there in November. Looks like we so far bounced off the 200-day moving average, which is right there, and so far we're not able to penetrate higher. The dollar and the gold move opposite directions. You can see that, generally speaking, gold and dollar spends most of its time negatively correlating to one another. You can see that gold and dollar are negatively inversely correlated, but on rare occasions they do become positively correlated. Here's that period, which basically started around February, where the dollar was rising and the gold was rising as well. But looks like right now, see, we have dollar is rising, and now gold is finally feeling the pressure. Where is it gonna go? Difficult to say as usual. But here's gold and GLD. Similar picture here. You can see that we bounced off the 200-day moving average basically. Here's gold in the weekly time frame. Here what I wanted to point out is this week's candlestick looks like a bearish engulfing pattern. So far it's not yet confirmed. We had a bearish engulfing pattern right there, and it did not work out clearly. You can see that this was a bearish engulfing because the real body of the candle engulfed the real body of the previous candle, but it did not work out because there was no follow through. Here we have a bearish engulfing which is much bigger than the previous one. It engulfs the entire candle. In fact, this is an outside reversal because we can see the top. This is an outside wick. So we can see the top of the range and the bottom of the range completely engulfed the previous candle. So this is an outside reversal. Whether or not it is a true outside reversal remains to be seen, especially if Monday we gap down. This could be a very bad time for gold bulls. Here's GDX on a daily time frame. Now we had basically reaffirmed resistance. So we have a rally that started in December here. Strong rally, very strong rally. Started in December and went actually above the 200-day moving average, this green dotted line. I pointed out this level repeatedly if you listen to my videos. Basically, we ran into that level right there, and the bears counterattacked, and this was the counterattack by the bears. Big plunge there. Continued lower, so we have, this was clearly a strong pushback by the gold bears. Additionally, we have market breadth data, which is deteriorating further. Looks like we had a bearish divergence here, which actually worked out and we see prices lower, more bearish news for the advanced decline volume rather. The other thing is that I have some of my proprietary indicators here. So this is a percentage of stocks within GDX on a buy signal. This is experimental indicator. You can see that right now we're oversold, but we are also not bullish. To get a bullish signal, we need to have, so the bearish signal occurred back here in August when we crossed below, I think this was like 10% or something. But we did not get a bullish signal ever since. So since last August, we were on this particular indicator, we were not able to recapture the 80% needed to turn this indicator bullish. You can see right there we had a good attempt, which is exactly the same level in November, by the way. And then another several attempts here. It came so close to 90, but we were not able to just push slightly higher, and eventually we rolled over. So currently it is oversold, but again, this is just one of the inputs for the total gold breadth index, and we were not able to recapture this indicator. So for now it is oversold, but it is also bearish. Additional input into the gold breadth index is this gold miners bullish percent, or I'm sorry, I meant to say on the next indicator I'll show you what I mean, but here is a gold miners bullish percent index. You can see it is rolling over. I want to emphasize that this is not one of the inputs to my proprietary gold breadth index. Here is another one. This is a gold miners new highs less new lows percent, and this is the first time we're actually seeing new lows appear since, well, we can zoom out, let's say 11 months. Probably more than 11 months. Yeah, it is the first time we're seeing new lows appear in more than a year, in about a year. So this is not a good news for GDX. Here's the same chart, GDX on daily time frame. There's my gold breadth index up here, GBI. Here's that same indicator I just showed, the percentage of stocks within GDX on the buy signal. All proprietary indicators. These are unfortunately not available on MasterCharts.com, so I had to create my own. But here's another one. Also experimental private indicator is a GBI, but it's a raw data for the input for this one. So here we actually kind of came up to 75% from the 50% low here, and this was promising, but now looks like we were rolling over. We already went to 62, and I almost guarantee that we will get lower, even lower from here. So currently it is oversold. Based on various indicators, for example, this indicator, and here's another one that is also my proprietary one. This is ITBM, Intermediate Term Breadth Momentum Oscillator, but for GDX. You can do chart school and try, do Intermediate Term Breadth Momentum Oscillator, ITBM, and you can see that this is there's a calculation on how to do it, and it's pretty useful indicator actually. It's a version of McClellan oscillator. There's quite a bit of ITBMs available for various market sectors, etc. So you can look up those indicators, but they're quite useful. So based on this particular indicator, I had to create my own. We are oversold, definitely oversold. So there could be a relief rally, from basically to relieve this drop from the highs here. But I wonder now about the longer term picture. I mean, right now we're still, according to GBI, we're still bullish, but we're just kind of in the middle. We're trying to either go higher or go lower, and so far I'm seeing that we're failing to go higher. We're really tried on this particular indicator and the percentage of stocks on the buy signal, and we failed, and this was since October. So, and then again we're rolling over on the raw data here. So I wonder again if we're not going to be able to recapture the bullish stance. We are you know, kind of like in between the bull and bear. It's really kind of difficult to say where we're gonna go from here. But nevertheless, we have to take a stance, and I do trade GDX myself. So this is my trade that we did here at MasterChartsTrading.com. I opened myself December 23rd here at $19.35. So I went ahead and I opened right there. And I always send the same thing for my subscribers. I calculate this on my Excel spreadsheet. So I have, entry, initial stop. So, and this is an ATR based stop, average true range. So how far away am I placing my stop? And I have 3 targets from my subscribers. So basically all 3 targets were met. Then I started taking profits. So I started taking profits here in January. I went ahead and sold half. We went up even higher, and then I started seeing that we're basically running into resistance. So I went ahead and I sold more, and I sold another half of my open remaining position. So I had about a quarter of position left up here. And then when we finally got this big drop, I went ahead and I closed the entire position, and notice that we're still continuing lower. So we don't know exactly where this bottom will be reached, and maybe we'll take out this lows. It's entirely possible again. So do consider signing up for MasterCharts Trading. You'll get very similar, information for the future. And this is about, on average, I went ahead and with all the profit taken, so it was about 25% or so gain on average with all the profit taken, basically. Here's West Texas Intermediate, light crude oil on a daily time frame. So this is a 52-week highs here, basically. And since then, we have more or less 3 iterations of bears attempting to resolve this thing one way or the other. I guess in this case to the downside. So we had one attempt that failed, second attempt right there, and now looks like we have a third attempt right here. So I wondered if the third time is the charm for the oil, and finally it will roll over and continue lower. Even though these are 52-week highs, I have a very hard time saying that this is a bullish security. The reason being is because these are multi-year lows here, and yeah, we rallied really strongly, but maybe this is a, like a dead cat bounce kind of thing. Additional, well, I'll get to that in a second, but the important thing is, looks like we have a consolidation back here in 2015. It's a 10-week consolidation. This consolidation we have now is a 12-week consolidation that still continues. Now, on the next chart, what I did is I zoomed in really closely. So this is basically the past 3 months. And I will try to make my bearish case for oil on this chart. So first of all, this is an inside wick that just pointed out right here. This wick is inside this week's range. For now, I don't see a bullish resolution here, even though we spiked higher. We didn't close higher above previous range right here. Just double check that. No, we did not yet close higher. Neither did we close lower. The only thing that what worries me, well, since I'm more bearish on oil, so what excites me, I guess, the most about this candle, and this is a weekly candle, the latest weekly candle, is this is the first time we actually closed below the low of previous week for this entire consolidation. So here we did not close below the previous week's low, and you can see we were just basically closing like right in the middle. So this one, even though it was by a few cents, it is still, like right here, what I see is the low of this week was 53 53.35, while the low for this latest week was 53.33. So we actually closed below this low, albeit by just a few cents. So technically we did close, but this is, again, this is a technical analysis. So additionally, this candle, even though it kind of looks like a spinning top, I think it's a little bit more bearish than this candle. The reason being is because we closed in the lower part of the candle, not very decisively, uh, but nevertheless it's slightly more bearish than this previous candle. So especially if we get follow through next week, then most likely my bearish case will be vindicated and we'll see a significant drop lower. I guess $42, maybe even $39 would be a good place to drop to. Alternative scenario is I'm wrong and it's possible and we break out higher, and then in that case this is a target around $62 or so. Now moving on to the energy ETF. This is very big, oil producers here and oil refiners, etc. So this is energy XLE on a daily time frame. Total return, in other words, dividends are added back into the price. So similar to the oil 52-week highs, but you can see that whereas oil traded more or less sideways to slightly, up maybe, energy ETF actually spiked and then traded down sharply. So it underperformed its underlying security significantly. So here we have more data. We have the advanced decline line and advanced decline volume line. You can see it is clearly making lower lows. And additionally, what worries me the most about this market breadth picture is that advanced decline line never made fresh highs. You can see that this high here is actually higher than this high here from December 12th. And you can see that we made a higher high here, and advanced decline did not confirm. Additionally, advanced decline line actually dropped to a new low for the move. So this low right here, 274, is below this previous lows from September of last year. The advanced decline volume line did hit 52-week highs, so that's a good sign. But looks like we are breaking support, if we can even call it that, and I'm moving lower. So it's a tough call, honestly, but it's possible that we are going to roll over and continue lower, especially if oil decides to go lower. And here's energy on the weekly time frame. You can see that we're still dropping, and this last week's candlestick, this is a weekly candlestick, is not very bullish. You can see that we closed in the lower part. If we closed above here, if we closed like around 73 or maybe 72.80, then I can certainly say that this is a bullish candle, but this is by no means a bullish candle. So we will see where this goes basically, but it is really iffy. I think that oil will resolve. If it resolves to the downside, energy will absolutely follow it lower. And here's natural gas on a daily time frame. Very volatile security, so be super careful trading it. In fact, I keep saying that you probably should avoid trading it altogether if you're a beginner trader. It's violent. So anyways, here's 52-week highs. Very, sharp pullback. We're kind of getting to the point of previous breakout, and this breakout is about this green line that I put in. And looks like we're attempting to bottom here, basically. You can see quite a bit of hollow white candles here, basically. Here's natural gas on the weekly time frame, and here's that breakout level at around $2.50. This breakout occurred here in June of last year, and we continued to fresh 52-week highs. and these are 52-week highs here, and then we pulled back rather sharply. So, but here's what I mean by a bullish looking candle. And this weekly candlestick looks a lot better than this candle from XLE. You can see that there's a lot of difference. Here the close was near the top of the range. We have a nice shadow at the bottom indicating that there was buying present, and the close was near the top again. So this is a hollow candlestick with lots of buying present. Also, we're kind of close to that area of support, and maybe this is basically it. And as far as the correction goes, maybe that was it for the natural gas. Alright, if you like what you're hearing, please like this video, comment, and of course share it with others. Of course, consider signing up for MasterChartsTrading.com, and please stay tuned on how to find us on the internet. Thanks a lot, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.